Good afternoon, good morning to everybody who's joined us for this webinar. Wherever you are in the world, thank you. My name is Paul Burlton. I'm an Associate Director at Lissus Financial, and I'm going to be hosting us today. I'll do some intros with everybody else in a second. But today we're going to be talking about a very interesting case that has just concluded, and I'll tell you why I think it's interesting. But I certainly think it's interesting anyway, and I think hopefully there's a lot of learning points in there. Just thought I'd kick us off with a quote. In this world, nothing can be said to be certain but death and taxes. Benjamin Franklin said that in 1789. And I think a lot of people have spent a lot of money and a lot of time trying to avoid paying taxes over the years. And I think the governments around the world have spent a lot of time and money trying to collect those taxes. So when the Panama Papers were leaked in 2016, I think it confirmed to a lot of us what a lot of people had suspected or thought they knew already. That there was a global industry of money laundering and tax evasion that was being conducted via offshore tax havens and shell companies. And at the centre of that scandal was Mossack Fonseca, a Panamanian law firm, which facilitated much of this. And if any of you have ever seen the film The Laundromat, you probably would have heard of them. If you haven't, then don't worry, we're going to explain everything to you now. I've got two of the finest experts in the industry on both tax and money laundering. So I'd like to introduce you to Sam Sheen and to Jayne Newton. Would you like to do some quick intros, ladies?
Passing the ball. Thank you very much, Paul. And many thanks to you, John Sweet, and the rest of the Lissus team for your kind invitation to take part today. So my name's Sam Sheen. I'm a financial crime prevention advisor. I've worked in the field for over 15 years now. I used to be a former regulator, and I host a podcast that you probably heard Paul on a few weeks ago called Captivated Audience.
Okay, so hi everybody. My name's Jayne Newton. I'm the Group Director of Regulatory Expertise at Efficient Frontiers International Limited. I've worked with the team at EFI for a long time. In my former lives, I'm a chartered tax advisor, and it feels like most of my career I've been dealing with these automatic exchange of information and regulatory developments to try and clamp down on tax evasion. So it's a great delight to be working with Sam and Paul this afternoon to look at one of these cases.
Excellent. Well, thanks very much for joining us. As I said, I think we've got some interesting information to share with everybody. As I said, it's related to the case. So I think in December 2018, the first case, I'll spit it out in a second, related to the Panamanian Papers actually came to court. And then in February this year was the first conviction. And that's the case that we're going to have a look at today. So Sam, first question for you. Can you tell us a little bit about what the case is about?
Sure. Well, let's move along. I think we have a couple of slides actually we can show in tail. And as Paul said, this was the first publicly announced prosecution from the Panama Papers disclosures from April 2016. And at the end of February, a gentleman by the name of Richard Gaffey, or Dick as he was known, pleaded guilty to several different offenses, including tax evasion, money laundering, wire fraud, willful failure to file certain accounts and records, and aggravated identity theft. So the key ones here for us are the tax evasion and the money laundering. But he also had to forfeit $10 million, which he had earned from this particular client in this case as a result of the advice and facilitation he'd offered to conceal both his identity and his tax residency. So this is a really interesting case for us, both for Jayne and I doing AML and tax, but it's especially relevant given the money laundering reg amendments that happened this January, where the existing customer KYC requirements have changed. More on that in a bit. So
who are the main characters in the story then?
all right, so the cast of characters is really interesting. So we have Mr. Gaffey, who I mentioned. Now, Mr. Gaffey, Richard, is the chartered accountant to a client named Harold Vondergotts. Let's just call him Harold. We also have someone named Ramses Owen. Now, Ramses Owen and Harold have also been indicted by the Americans. Harold has agreed to plead guilty to tax evasion. He was supposed to have been sentenced by now, but due to COVID, that hearing's been postponed, and Ramses' case is still ongoing at the moment. So anything we say about Ramses should be parentheses with alleged, because they've not yet reached a final decision on him. So what do we need to know about Harold? Well, Harold is actually a German national, so he's born in Germany, but sometime in the mid-1980s, he moved with his family to the United States. We know that Gaffey, the accountant, was a partner with an accountancy firm that he formed, and he had been a long-standing family advisor to the Vondergottses, and he was also based in the United States. And what we know about Owens, of course, is that Owens worked for Mossack Fonseca, but he worked very closely with the trust and company formation arm known as Mossack Trust, and he really specialized in creating shell companies, providing nominees, giving advice basically on how to creatively avoid taxes, according to his indictment. And in fact, there are a number of allegations that are slightly more serious in relation to the extent to which he facilitated for a number of clients questionable tax arrangements.
Gotcha. So if we kind of wind the clock back then, so how did it all start?
Okay, well, let's remember Mossack Fonseca is a firm based in Panama. And as I said, they have the Mossack Trust arm, which offers trust and company formation services. So the story begins here in the 1980s, right? And what happens, or actually it winds back even further. I said the 80s, didn't I? It actually winds all the way back to originally the 70s. So Rudiger Vondergotts is Harold's dad. And he ends up becoming a very successful businessman in South America. In fact, he becomes the largest coffee exporter in South America. So he accumulates quite a bit of wealth, and he decides he needs help managing all this fabulous family wealth. So he hires Mossack Fonseca to set up a structure for him. So they set up a trust for him, and they set up a series of companies in which he settles both proceeds as well as assets that he holds at the time. So the trust is created sometime in around 1988, and it's settled as a BVI trust, and 7 companies are set up. They're mainly BVI international business corporations and equivalent Panamanian corporations. And so the main thing to know is that in about 1990, Rudiger dies, and Harold, who is the primary beneficiary of the trust, is now, if you like, in control or fully entitled to all the assets that have been settled into this trust structure. So for our purposes, there's one company of the 7 that's most interesting, and its name is MJO Investments Limited. And we've got a slide where you can see it sort of reflects the timing I just talked about. It's created in the mid-1980s, and about the time the trust is settled. It's been around for some time, and you can find all this information on the ICIJ website. So just keep MJO in mind for the rest of this description. So the next relevant thing that happens is in 2007. So we're talking 27 years after Rudiger has died. A decision is made that they're going to change the structure of the assets held in the trust. So what happens is Mossack Fonseca, through Mosfon, helps Harold to resettle the trust into a Panamanian foundation, which they call REVAC Holdings Foundation. Okay, all the company's shares are resettled into this. So they've moved from one type of structure to another. Now, as you know, foundations have slightly different documents from trust documents, but they do have regulations, and they have specific rules for different people. So Mossack Fonseca is the resident agent, Harold's the founder and manager, Owens is a member of the foundation council, Gaffey's identified as a substitute manager, and the main beneficiaries are first and foremost Harold, followed by his wife and his children. Now, the funny thing about this is they talk about the objectives of the foundation, and they say, you know, it's set up to maintain the wealth of the family. Harold is able to make future contributions to provide for liquidity for future investments, and that those investments can be in private equity, real estate, or fund investments that have been thoroughly researched and are fit to the philosophy of the founder, in other words, Harold, although he hasn't told us exactly what his philosophy of fun is, but we'll leave it at that. And the other thing that's hilarious is the objective of the structure. As I said, it's to maintain those assets originally settled by Rudiger and added to by Harold, but it states that if any member of the family engages in reprehensible conduct or marrying an unacceptable, troublemaking, or gold-digging spouse, they can be disqualified from receiving any assets. So that's essentially how the structure was set up. And really by 2012, it was very, very lucrative, and it was worth about 35 million American dollars.
Wow. And an important point there as well, the kind of nota bene at the bottom, no mention of any mother there, right? So that's important when we come to that later, yeah?
Absolutely. And interesting, just as a bit of a side note, it turns out that Rudiger and his wife didn't really get along. And just in or about the time that he passed on in 1990, it turned out that they were already talking divorce, had never formally done it, but were estranged from each other, literally not on speaking terms.
Gotcha. Okay. So I'm going to flip over to you now, Jane, because I think we probably need to explain a little bit about FATCA, because FATCA is quite important in this story. So do you want to tell us a little bit about FATCA and how it applies to US residents?
Okay, thanks, Paul. So I'm pretty sure you've all heard of FATCA, and this acronym stands for Foreign Account Tax Compliance Act. It was introduced in March 2010 by the USA. Its main objective is for the IRS, so that's the US tax authority, to clamp down on US tax evasion by receiving information about financial accounts that are owned by US taxpayers, both corporate and individual, and held with foreign, so that's foreign to the US, financial institutions. So we'll refer to these as FFIs in this webinar. So the FATCA regime is based on US citizenship, and the information received by the IRS enables them to enforce the US tax code. So basically, the IRS uses the information they receive to check the tax filings of US citizens. The IRS may then decide to investigate US taxpayers if they detect discrepancies. So there's a key element to FATCA, and it relates as follows. Broadly speaking, there's a key element to FATCA, and it relates to information sharing. So broadly speaking, FFIs must collect and report on information about the US status of account holders. So that's both individuals and corporates, including in some cases the individuals behind those corporates. In AML, you'd refer to these individuals as beneficiaries or beneficial owners, and some of the types I'll mention later on. So the FATCA due diligence and reporting obligations of FFIs depends on whether the country has signed an agreement with the US to share that information, where a customer's bank account or accounts, if they've got more than one, are located. So there are two types of these FATCA agreements. There's Model 1 and there's Model 2. And whilst I won't go into detail here about their differences, one of the significant ones relates to annual reporting. So for Model 1 agreements, FFIs in those territories need to send the information about reportable accounts directly to their local tax authority, who will then exchange this information with the IRS. For Model 2 agreements, FFIs need to send the information directly to the IRS in the format specified under the agreement. There is also a third category, and this is where there's no agreement in place, but there are some fairly complex rules around these, and they're not directly relevant to this case, so I won't go into those here.
Okay, so FATCA presumably is related to the structure that Sam just described. Do you want to talk a little bit more about how that relates to that specific structure?
Of course. So in terms of what I've just described, the FATCA obligations relate to the information collected about the US status of individuals and corporates. So firstly, in this case, we have a trust and companies, and they're all offshore, so they're all non-US entities. The key here is if they have financial accounts held with FFIs. So the second point is that these are all old structures. And in other words, they existed pre-FATCA. And as I understand the facts, they may have had financial accounts. So for MJO and any of the companies involved in this case, wherever the accounts were opened, any FFIs providing the accounts, as I mentioned, would need to comply with the FATCA due diligence obligations that apply. So for accounts opened on or before the 30th of June 2014, they would need to perform pre-existing account due diligence to identify if any were US reportable. Now, the IRS agreed that a risk-based approach could be applied to pre-existing accounts. So for entity accounts, a threshold could be applied. So any that had a balance or value of less than $250,000 as at the 30th of June 2014 didn't have to be reviewed until at a subsequent 31st of December, the balance or value exceeded $1 million.
Yeah, and Jane, I mentioned before that in 2012, the trust was worth about, or the foundation was worth about 35 million. In actual fact, at about 2009, it was worth double that. So it was worth between 60 and 70 million dollars. And part of that whole asset valuation included a number of accounts. So I think we can assume that some of the accounts must have been caught then, given what you've just described.
Yeah, so let's assume that's the case. So the next step is to start to apply the tax KYC due diligence process. And when we refer to tax KYC, we mean the information that we hold for tax reporting purposes.
So, so reading through the case notes, there are a bunch of papers that are mentioned and tax forms. You know, having lived in the States myself and worked in US banks as well, you know, I remember my W8s and I remember my F bars. And can you just explain how they're relevant to this case?
Of course. So I described earlier the first part of the FATCA KYC process. So first we collect tax information from the customer. So on receipt, it must be checked to ensure it's fully completed and then validated against the other information held about the client. So for example, based on information held in the AML KYC data, if there's reason to doubt or question the tax information provided or their US status, then we would have reason to doubt. So this tax KYC can be a really useful source of information to identify when we may need to update the AML KYC information and vice versa. So going back to this case, there are 3 forms that are worth mentioning in the case. So there's the IRS Forms W8BEN and W8BEN-E forms, which are generally completed by non-US individuals and entities to certify their non-US status when they're opening a financial account, like a bank account. So the information on these forms is checked against AML KYC to identify if there is any US indicia that may give the FFI reason to doubt the non-US status. And these forms allow the customer to access a withholding tax rate applied to US income and assets, which is lower than would be the case if the US 30% withholding tax rate was applied. So that's the W series forms, and those are IRS forms. The F-bar requires US taxpayers to identify the financial institution at which the account is held, the type of account, the account number, the maximum value of the account during the calendar year the F-bar is filed. So when a US taxpayer beneficially owns a financial account outside the US but fails to disclose this on the F-bar, this is referred to as an undeclared account. So it's all part and parcel of the IRS enforcement activity to make sure that people are declaring correctly the income they receive and paying the US tax that they're liable for. And there is a form for gifts received from non-US persons, but I don't want to give away everything at the start, Paul, so you'll have to wait and see about that one.
Yeah, I've got a feeling that might be important. So the banking activity, right? So what was happening around in the banks at the time? What were we seeing then there, Sam?
Well, they primarily use 2 jurisdictions for bank accounts for both MJO and then for the foundation itself. And the 2 jurisdictions of choice for this were Panama and Switzerland, and both Gaffey and Owens assisted in setting up those accounts. But there's some other jurisdictional connections to this as well. We also have the fact that Harold decided he wanted to live in Florida because apparently it had a preferential tax rate that he enjoyed, and he ran an investment business with another partner in the USA. And of course, I said earlier that he moved from Germany, where he first started his life, in or about the mid-'80s. So there are a number of different jurisdictional connections, and as Jane mentioned before, that's pretty relevant to trying to figure out then about the sharing of information and what needs to be reported. So Jane, at this point, how does that information help you, or what do you need to find out?
Okay, so Switzerland signed a Model 2 agreement in 2014, and Panama signed a Model 1 agreement in 2016. So financial accounts opened by US citizens in these jurisdictions can't escape FATCA due diligence to identify them, even if the accounts were opened before the FATCA regime commenced, because due diligence applied to pre-existing accounts. So those are referred to as accounts which opened prior to the regime commencing. And as I mentioned, the tax KYC due diligence exercise. So we have the accounts. We know where there are accounts held in the name of the trust and MJO, according to the court materials. And the purpose of the exercise is to decide whether we need to dig down to the natural controlling persons of these entities. Now, in this case, we're focusing mainly on MJO. So Sam, you mentioned that MJO is a non-US company. So we then need to ask the question, is it a passive non-financial foreign entity or a passive NFFE? So there's criteria in the regulations that need to be applied in deciding whether an entity falls within the passive NFFE classification. And if it does, the regulations require that you identify for tax KYC purposes the controlling persons of that entity. So although similar, it's not the same definition that you might work with for AML purposes. So you'll see, as described here on the slide 10, our controlling person definition essentially rolls your UBO and controller definitions into one. We don't have information about all of the evidence the banks had in this case, but let's assume that MJO meets the passive NFFE definition, and so its controlling persons need to be identified. So that would have meant that the banks in Switzerland and Panama would need to identify these individuals and see if there was any US indicia.
Okay, well, we know from the case facts that Harold was known to be the UBO for AML purposes and the beneficiary of the foundation in relation to the banks in Switzerland and also by the banks in Panama. Although for the bank in Switzerland that was open for MJO, he's formally identified in the account opening documents as the authorized signatory.
Gotcha. I'm just going to remind, I think I forgot to say at the beginning, if people do have questions, there is a Q&A function. I see somebody has discovered it. So there's one question has popped up, which is good. We'll be doing Q&A at the end. So please feel free to put your questions in as you think about them. And then hopefully we'll have some time for Q&A. Okay, so as we go through then, so I remember 2013 being a critical period during this story. What happened in 2013, Sam?
Well, everything's chugging along nicely the way you would expect wealth structure like a trust or foundation to operate. We described how it was set up. We described the event of Harold's dad dying. We described the resettlement of the trust into a foundation, but then in 2013, Owens, the lawyer, who at this point has moved out of Mossack Fonseca, started his own law firm. He helps Harold to change the foundation documentation, takes Harold out as the ultimate beneficiary of the structure, and puts Harold's mother, Erica, in as the ultimate beneficiary. Now, she lives in Guatemala. And at the time this case was brought to court in 2018, she was over 100 years of age. So we're not entirely sure why or what initiated the change, but I'm surmising here that perhaps they saw the FATCA legislation was coming over the horizon at that point, and that maybe they were thinking, gosh, we're gonna have to think of different ways to deal with Harold's beneficiary disclosure. Is there some way to conceal it? It just seems to be awfully coincidental and convenient timing.
Yeah, gotcha. That makes sense. And what was Harold doing with the foundation and the companies associated with that?
Well, this is where it gets really interesting. So it seems as though the types of financial transactions that were being engaged in by MJO for the benefit of Harold, according to the prosecutors, fell into sort of three categories. So you had your first category, which were sort of donations and personal expenditures. And in essence, that first category was a bit like using MJO as a wallet co, is what I would describe it. The second one was in relation to investment-related transactions. And the third was a gift from his mom.
Hence the title of the webinar. Yeah. So let's go through these one by one from an AML perspective and a tax perspective. So the first one is category is donations. So what did those entail?
Well, this is really interesting because you do see this from time to time on traditional trust structures set up to maintain family wealth. So what we see are quote unquote donations being made by Erica through MJO to Harold's children and grandchildren's schools, for example. But you also see payments coming out for other things like personal loans, a payment to pay off the mortgage on Harold's house, but also stuff like buying art, funding hunting grouse trips, which is essentially hunting a small bush-like fowl, and even renting a private plane hangar. And on top of it, Harold had a couple of side businesses. I mentioned he was an investment manager, but on top of that, apparently he was funding an exotic watch company and was using the proceeds out of MJO to also finance a rainforest excursion company where people who came off cruise boats could, go for a day trip and walk along, those sky walking platforms to go through the forest. So we know that over a 6-year period, Harold received about 1.4 million into his personal bank accounts from the accounts that were nominally held by MJO, and that he used a lot of that money also to pay off the fees that he owed Gaffey and Owens as well.
Gotcha. So from a tax perspective, clearly looking at the facts of the case, there was a disclosure issue around tax. So how does that help him evade tax, those types of transactions, Jane?
So by making incorrect tax filings for the money extracted from MJO, that may mean that the payments made by MJO and the receipts received by Harold won't be treated correctly for tax purposes, and the tax rules are being circumvented. It's important to remember though, Paul, that the tax authorities do have many sources of information, not just that provided by the FFIs. So it's often the case in tax prosecutions that suspicion is initially aroused because the individual's extravagant lifestyle isn't backed by earnings declared in the tax return. In this case, it looks like the lifestyle is backed by old family money.
Right. And Sam, any thoughts on that?
Yeah, well, first, when Jane first told me that the tax authorities can keep track of things like the car that I'm driving and whether I'm taking lots of luxurious holidays, I became terribly concerned. Not that I get to go on any right now, obviously. But the thing that I thought really odd about this was I would expect things like possibly loans given in lieu of distributions to try and minimize the tax impact on payments out of a trust or a foundation, because that was an old tactic used to reduce your tax liability. And I would expect to see things like donations or tuition coming out for school fees. But things like paying off your personal mortgage is odd. You would think with a family trust structure or foundation structure that the house would have been settled into its own separate corporate entity and that payment of his mortgage would be done within that, as opposed to just doing a straight personal payment to Harold to pay it off. And also the stuff about the entertainment and the grouse hunting and stuff, that wouldn't seem to entirely fit with the profile of the structure.
Right. And then the relevance to FATCA in these transactions, Jane?
So I mentioned at the start about what FATCA requires, and that's information about financial accounts held by US persons with foreign financial institutions. So one of the big differences between AML requirements and FATCA is that FATCA doesn't require FFIs to monitor sources of wealth or transactions. So it looks like they were thinking that if it looked as if MJO was the one receiving the sale proceeds from the shares, it would not be reportable as income earned by Harold, because as we know, he ends up receiving some of this money himself. So the question here for FATCA purposes is first whether MJO is a passive NFFE. And to answer that question, we would look at the KYC held for MJO at the bank and any publicly available information, documentation or self-certification that was submitted on its behalf. So if we assume MJO is a passive NFFE, then the bank would need to collect the tax KYC in relation to the controlling persons to determine if any are US reportable. But you would go to the authorised representative to obtain that kind of information, not necessarily directly to the controlling persons themselves.
Right, gotcha. Okay, that makes sense. So what about the second one, the investment-related transactions and the associated businesses? They're obviously very different, Sam.
Yeah, they are. And this is particularly naughty from a financial crime perspective, Paul. So I mentioned before that Harold has a investment business. It's called Boston Capital Ventures. It's a general partnership which he co-owned with another individual. And that in turn helped to establish a group of private equity partnerships. So yeah, he had two particular entities that were set up as investment vehicles. Let's just call them number 3 and number 4. He then arranged to have MJO and a couple of the other companies beneficially owned by the foundation to invest in shares of a particular entity that was a technology company. Okay, now that company made an initial public offering in 2012. Okay, so follow me here. The foundation, which beneficially owns MJO and a couple of other companies, those companies invested in this technology company, EXA. And shortly after this, an IPO happens. So following the IPO, Credit Suisse, who is acting as broker for the two vehicles, 3 and 4, for distribution of the EXA shares, okay? Harold and the companies all decide to sell their shares in EXA, and then the distributions are paid out. So that doesn't sound too problematic, right? That's just fortuitous. They own the shares, and then there was an IPO, and they went, hey, the value of my shares have gone up. Let's take advantage of that and make a profit. Well, it would sound pretty vanilla, except for the fact that Harold's daughter and her business partner both worked at the Credit Suisse trading desk and helped make some of the distribution arrangements. Not only that, they handled all the sales, and when Harold filled out, there's a special form that has to be filled out that basically says that no immediate members of the family acted in concert or closely associated with the transactions or had sold any shares in the preceding 6 months to the current situation. He lied and said no, that actually didn't happen. So we have there really interesting distribution of money, but the long and short of it was those monies went through the MJO entity and then came out the other end to the benefit of Harold. So we have a little bit of market abuse going on there, and we have some dodgy sort of payout arrangement.
Right, and I'm presuming there's been no recourse to Credit Suisse on this at the moment, right?
If there has, we haven't heard about it.
Yeah, fair enough. Presumably their letter probably covered their backsides. Anyway, and then let's go to the third one, Sam. So this is where the gifts come in. Just guessing by the picture.
I know, and clearly Harold's mom really, really loved her son, right? So essentially, mom is feeling super generous and decides that she's going to gift Harold $430,000 from the MJO account held at a Swiss bank. Now, here's the important thing to know about this. Owens helps set up that bank account for MJO, but Harold ends up being a little bit sloppy. So he's on there as an authorized signatory, right? But he actually goes and visits the bank representatives at some points in time, right? So they actually kind of know he is really the beneficial owner. And at some point in time, he must have given information to the Swiss bank that he was resident in the US. Okay, so this transaction took place in about 2013. So that's after Erica's put on as the new beneficial owner of the foundation. So she makes this lovely gift to him. And he ends up filling out some forms to say that the gift was given to him from his lovely mother, who of course is not a resident of the United States. So all pretty odd, but it turns out that that $430,000 wasn't simply sitting in that account by fluke. It turns out that those funds in that account were the result of the liquidation of shares that had been held in a precious metals business that was held in the account. So essentially, somebody arranged for those shares to be sold. The proceeds were put in that account, and what a coincidence, Erica decided to give him a lovely gift.
Very interesting indeed, very interesting. And then going back to FATCA, the relevance of the gift and from a FATCA perspective, Jane?
So there is no relevance of the gift from a FATCA perspective, as for FATCA reporting, account information is reported, but not transactional information. However, based on the case documentation, it appears that Harold reported in his 2013 US tax return that the money was a gift from his mother Erica. Presumably under the US tax code, this meant that he didn't have to pay any US taxes on those proceeds.
Gotcha. So it sounds like Harold had a pretty good thing going here for a while. You know, and the case obviously explains to us that how the proceeds, you know, were able to prop up his lifestyle. He had things like the personal watch company, you know, he had this kind of good lifestyle, everything else. And I think there was a memo from Mossack Fonseca noting the assets in his trust and foundation trust were worth between 60 and 70 million, we said, right? So, you know, clearly he was doing all right. But I think, you know, obviously the penny started to drop. So was it the Panama Papers that brought this to light, or was there something else happening at that time?
So according to the case documentation, it appears that Harold compounded his problems in 2014. So we understand at that time the Swiss bank informed him that under the new FATCA rules and the Swiss banking program run by the US Department of Justice, the bank had identified that his account was US related because he was a beneficial owner and had US resident status. So as such, they told him they would report his accounts to the US and made him aware that the IRS had opened a voluntary disclosure facility, the IRS OVDP. That facility enables US taxpayers to regularize their tax affairs in advance of the IRS coming to find them first.
And it was great because, you know, Harold responded the way, you know, as you would expect him to do. He, of course, arranges for a lawyer to make the disclosure, right? No. What Harold actually does is he works with Gaffey and Owens and he amends his F-bars for the 4 years prior to just compound the problem and make it look worse, and kept trying to keep going with the lie that he really wasn't the beneficial owner of the proceeds in that bank account.
Gotcha. Okay, so just compounding it. And the Swiss bank presumably did the right thing. This was post FATCA being implemented, right, Jane?
So it was as Switzerland had signed the Model 2 agreement, and based on the information available that we can see from the case documentation, the Swiss bank did the right thing at the time. It had to comply with its regulatory obligations to report, but it also fulfilled its duty of care to Harold in providing information about the existence of the US disclosure facility without inferring that they thought he may need to use it. So when there are conspiracies to falsify documentation and conceal beneficial owners and controlling persons, the FFI should consider what it can do to defend itself from accusations that it facilitated the crime.
Right.
So ensuring that governance and control frameworks are robust and that procedures are effectively implemented is really key to managing the risk. And from a tax reporting perspective, ensuring that there's an audit trail to support the reporting decisions made is also key.
And I'm just going to throw a curveball in here, Sam, right? But surely Credit Suisse would have done their due diligence on Harold and his source of wealth, right?
Well, yeah, and in actual fact, they did have information from Owens and Gaffey about the foundation and the fact it was set up in Panama and the underlying entities. That it wasn't that they were at a loss of it. I think really the problem that the bank had in that case wasn't so much that they didn't know who it was in terms of the foundation account or the MJO account. It's just they didn't seem to notice that the transactional activity started to veer off from what the objectives of the foundation were.
Yeah, no, exactly. And then there were some additional efforts, right, to try and maintain Harold's, let's call it, preferential tax treatment. Yeah.
Yeah, well, you know, I have to say, Paul, I don't know how many times the people don't get the message, which is if you're going to commit a crime, it's really good not to put it in a PowerPoint. I mean, how many cases have we seen now where, you know, the smoking gun is now somebody with a PhD in PowerPoint who's mapped out the whole scheme. So good old Owens, according to his indictment, took a trip to London and was expecting Erica to have died or to die soon by then. And he was putting in a proposal in this PowerPoint presentation that he would step in as the beneficial owner on all the documentation and thus keep perpetuating the magical story that Harold really was never the beneficiary.
Genius. And then he's set up some US bank accounts as well.
Yeah, now here's where it's a little bit different. So you've got Owens and Gaffey setting up these accounts in Panama and Switzerland, right? And they're being fairly straight up, so to speak, but those two jurisdictions have a pretty good idea, right? Who are the parties involved? But for the bank accounts in the United States, it's a different story. So they made concerted efforts to make sure when they opened bank accounts in the United States, there was never any reference to Harold. So between 2010 and 2013, the two of them helped Harold set up accounts in the name of MJO at banks in both Boston and New York. And when they sent emails to the bankers there, providing them with KYC, an explanation of what MJO did and its purpose, they made sure that they didn't provide any information about Harold, but they took it one step further. And instead, Gaffey gave those banks the date of birth, the passport number, the address, and additional identification for Erica.
Gotcha. And then the Panama Papers disclosure happened, right?
Yeah, and this is just where, you know, you're like, oh, Harold, give it up, dude, stop already. So, you know, he's got one warning from the Swiss, right? I mean, he's on notice. Okay, things are getting bad, dude. Have to do something. So the Panama Papers come out, and actually he gets offended by the news article that he says is exaggerating the story about him. So he tries to hire lawyers to see what he can do. He's trying to send in an explanation to the Department of Justice and the IRS to say it's totally exaggerated. But, you know, he was just digging himself in further and further. And the thing that became the problem, of course, is with the disclosure of the Panama Papers documents, it showed the account opening documents that I mentioned in Panama and Switzerland that named Harold as the beneficial owner. And really, the sum total of it was with all of these entities, Harold didn't once put his hand up and say, yeah, I'm really the beneficial owner.
And I think this was the bit that got me in the laundromat, was obviously completely unrelated. There was a case related to his Rainforest Company, right?
Oh, and this is, I mean, truly, again, this is why you really want to prepare your client when they're going to go through discovery or deposition. So two people had an accident while going on one of these excursions in the rainforest, and so they sued his Rainforest Company, which was called Rainforest Tram Limited, and it was a part of the foundation. It was beneficially owned by the foundation. So opposing counsel had figured out that MJO was somehow involved with this Tram Limited, so began asking Harold these questions about the relationship between the two companies. Then he started asking him about the foundation. And somewhere along the way, Harold must have said something about his mother decides things, because he said, well, you know, does your mother lack capacity? Because at that point, it was 2017. I believe she was 101 at this point, and she was still alive. And Harold said, oh, but, you know, my mother was never a businesswoman. You know, she trusts her advisors. And then they said, well, do you have access to our advisors? And he would say, well, yes, of course I do, because sometimes I have to clarify things that my mother means. And they said, well, do you instruct on the transactions? And then he sort of, it was a bit like saying, splitting hairs, going, well, what do you mean by instruct? I have to clarify the things that she means. And then when we got to the question of, what about paying for your daughter's education? What about the very nice gift you received? He tried desperately to try and make it sound like, no, his mom genuinely meant to do all these things. And it was at that point that at the same time he got questioned about the New York Times article that came out about the Panama Papers that had outed him as a tax evader. And he just pretty much made a complete snafu of the whole thing. And it was that evidence about his mother and his influence over her decisions that really brought to bear what was actually going on.
Gotcha.
And, oh, I should also mention that it turned out dodging taxes was apparently a family endeavor. So it turns out that Harold's 2 adult children also applied to go into one of those programs that Jane mentioned, those IRS amnesty programs. And one of his sons disclosed he had an undisclosed bank account in Panama. Surprise, it was held in the name of MJO, and that the other brother used offshore entities as well to evade taxes. And guess who prepared both tax returns for those sons? Dick Gaffey.
Yeah, of course. So it's really easy, isn't it, going over all of those facts now? The benefit of hindsight, it's so obvious, isn't it, that how many indicators there were around the tax evasion, effectively then, the fact that those are then proceeds of crime, that then becomes money laundering, etc., etc. So lots of red flags. But would you have said it was that easy for the banks to spot that, Jane?
So this is what FATCA is designed in part to address, and that is to identify wealthy individuals shielding themselves behind opaque and complex corporate structures. But it doesn't solve everything. And as I said, it doesn't monitor for transactions. So if someone wants to falsify documentation, it's very difficult at times to detect that. But this is what Sam and I talk about. The reason we need that collaboration between the AML and the tax KYC teams to detect those tactics that FATCA alone wouldn't detect.
Gotcha. Sam, what about you? What do you think?
Well, let's go full circle to the remark I made at the start. So I mentioned the amendment, the ZB, which is a transposition of the 5 AMLD's revisions around existing customer KYC, which now introduces a trigger where you're legally obliged to interact with the customer, if you will, in relation to their tax obligations, that at that point, that may be the trigger to review their KYC. Well, it's obvious in this case, right? There were things that potentially, from a KYC perspective, it was a long-standing customer. It was a long-standing account, right? So unless there was something truly abnormal picked up by any of the 3 banks, it might have just continued. But the tax triggers certainly may have been the opportunity to find it. So in this case, the Swiss bank, because of the tax trigger, looked around at all its American customers and realized that Harold had a link to the United States, and therefore he might be reportable. So that link we now have in ZB for existing customer due diligence not only means that there's an additional trigger which might help us spot people engaging in crime, but it also means we're going to have to get a bit more savvy about understanding what tax evasion actually looks like, because the tactics aren't really clear-cut.
Yeah. I mean, one thing that really sticks out to me is I've read through this now probably 4 or 5 times, and every time I look at it, something else, grabs me in terms of, what else can we learn from it? One of my key learnings, I think, is collaboration and cooperation. So you've got a bunch of AML KYC guys who are, KYCing the account, the companies and the UBOs. You've got the tax KYC guys. You've got the transaction monitoring, AML transaction monitoring guys. What do you think around, the lessons learned in terms of collaboration that this case teaches us?
So I think it really emphasizes the fact that the teams dealing with the compliance. So whether that's your AML KYC teams, your front office tax teams and your back office tax teams, everybody needs to communicate and know and understand what those red flags are, so there can be processes implemented to raise those, and not just each team deal with it in terms of a silo.
Sam, any other thoughts?
Yeah, I think that the days of us being able to have KYC tax specialists and KYC AML specialists are rapidly disappearing. You know, when we're talking about customer risk profiles, I think there's going to have to be a much more integrated approach between those teams, because clearly there's things we can learn from each other in terms of the triggers, but for the speed at which we can do activities now, it means we're going to have to be super efficient in terms of following those trail of breadcrumbs, and communication between those teams, or even integrating that KYC exercise, is really going to be key for those reviews. Yeah.
Okay, well, thanks very much. I'm going to go to questions in a second, but just some kind of final thoughts. So clearly, you know, tax evasion and money laundering are linked, right? We can see the evidence here. I think this case is a really interesting one. It is complicated, but I think it is really, you know, interesting to go through all of these red flags. And, you know, it's actually quite amusing. And I think that's what makes it good, because, you know, some of these things are actually laughable. And you're thinking, well, could they happen today? They probably could. So, you know, that's something to kind of take away. You know, I think red flags in one of the domains, you know, should trigger investigations in the other. I was thinking about the collaboration between the teams and the people, and what you said, Jane. But I also think that's where, you know, I think technology can help us, you know, sharing data across those different domains and you know, cross-referencing data points. You know, the technology can work through all those transactions and look at the transactions, look at the tax statuses, look at all of the, you know, the companies that are connected and make all those connections, I think. So I think there's a lot of lessons to be learned there, and I think it's a really good case. So thank you very much for taking us through it, and making it so interesting. So I'm just going to go to the Q&A. I've got a couple of questions on here, so I will read them out and we'll see how we can do. We've got about 10 minutes left, or 8 minutes left. So questions on the FATCA certification for US, I can't actually read that word.
Indicia.
Indicia.
US
yeah.
indicia.
Yeah. So does it apply to US persons that are considered underage? So
the answer is yes. Children aren't exempt from tax. It's just in many jurisdictions if there's a personal allowance, many children have income, but it falls within that allowance. So yes, it's not documentation that needs to be completed if you've reached a certain age. And it's interesting from the US perspective that in the US, most children born in the US are issued with a tax identification number at birth, which is a key piece of information that needs to be collected if they're reported. So absolutely must collect the documentation if the beneficial owner is a US person. Often accounts are opened, if you see a plain vanilla bank account, it's opened by a bare trustee, so possibly the parent. But the tax residency information that has to be collected in the US status does relate to the beneficial owner, and if that's a child, that equally applies.
You get your US tax status chip inserted at birth these days, right, Jane? Excellent. And then the other question I've got here is, do you think that machine learning transaction monitoring could be utilised if the KYC information were made available from different teams, identifying unusual patterns? And, you know, I certainly believe that technology can definitely help. I think, you know, there's a big data problem here and there's a little data problem here, isn't there? But there's definitely a sharing of data issue, and looking at all of those data points. However, I will say, you know, I think it's the humans and the machines, because you need the expertise as well, and you need to see these, you need to be able to, there's no computer that can read this prosecution and determine a fact pattern to build a machine learning algorithm to pick up these types of activities, right? I mean, I don't know what you think on that one, Sam.
Well, really interestingly, there's a fellow financial crime professional working over at Deutsche Bank in Germany, and she used some AI on the wealth management line of business to see if it could pick up patterns. And interestingly, although it did pick up some patterns, it had misidentified some outflows as muling, when in fact it was exactly as I described. It's payment of kids' boarding school fees, tuitions, etc. There were a few other things it couldn't properly identify because the nature of wealth management and these type of structures don't always behave the way you would expect them to. But conversely, it did pick up the misuse of some family wealth structures, which was really interesting. So I think the challenge with this would be analogous to that, and that is, I don't think as AML professionals, we truly understand what would be a typical transaction that for tax purposes is perfectly fine, or one in which further investigation is warranted. So I think that human element of the analysis is going to be really crucial to bring that stuff together, but it's also going to require some, I think, cross-pollination of knowledge about what are the tax requirements, and like I said, is it really a loan, or is it simply a distribution and someone doesn't want to pay the tax on it?
I would endorse that, Sam and Paul, both of your comments. And I'm a huge advocate of using technology, particularly in the risk management and detective controls when tax processes are going wrong. But it's really important to note that in terms of these FATCA and the common reporting standard rules, there's this concept of a relationship manager. So it's not just information that you hold in your systems. It's the information that may be recorded in someone's brain, not recorded in the system. So relationship managers have a key part to play in determining whether there is reason to doubt the tax information that's held and monitoring for changes in circumstances. So it's a good combination of the two is the best outcome, I think.
Gotcha. Okay. So just in the interest of time, I am going to wrap it up. Firstly, I was just going to ask one final question, which is if people want to find out more about this case, where should they go, Sam?
Oh gosh, where can they go? Well, you're spoilt for choice. If you want the DOJ's version of things, you can definitely Google this one on Department of Justice, February 2020. But the ICIJ have both a brilliant database that connects all the structures together, but also a great summary explaining the case. You can also read the indictments if you're really curious. You can find those on courtlistener.com. Really, really good case, though, if you want to teach people.
Gotcha. And then I'll just say that if people want to continue the conversation, we have our LinkedIn group, which is the AML and KYC Leaders Group. Lots of interesting stuff posted there, and feel free to ask questions if you didn't get answered in this session. I'm assuming that you're all okay if people reach out directly. I am. If anybody has any questions and wants to come directly to one of us, we'll be more than happy to answer your questions. Finally, I just want to say thanks very much for your input. There's a lot of work has gone into this. As I said, it's a complex case, and I think you've done a brilliant job in explaining it in the way that you have done. So thank you very much for your help with that.
Cheers. Thanks for inviting us.
And thanks to the listeners.
Thank you. Bye.